morning, Rare ECN listeners. This is your weekly FX update brought to you by Rare ECN. This week's commentary will be broken down into the pound-dollar market. Rising concerns over the EU double-dip recession is jeopardizing the UK's interest rate expectation as the MPC rhetoric turned dovish. The pound-dollar pair consolidate near the 1.600 mark after a week long of lower lows ahead of today's highly anticipated UK GDP report. This commentary will be broken down to two components. The first component that we will explore is the technical front on the pound-dollar market. The narrative for the pound-sterling price action so far this week has been tainted with lower lows and lower highs. Currently, the pair is trading between the 23.6% Fibonacci retracement, which formed a near-term resistance at 1.6184, while the 14.6% expansion at the 1.59910 forms the immediate support tier. Failure to sustain trading momentum during the release of today's UK GDP print would only risk the pound to the next support tier at the 23.6% expansion marked by the 1.58725 zone. Since the pound-dollar pair is trading so close to its support tier just ahead of today's major risk event, analysts does not believe that entering into short position at this point would justify its risk and reward profile. Having mentioned that, the lack of reinforced bullish bias would not justify long position either. A hold recommendation is highly advised. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, retail traders' long interest on the pound is showing signs of gaining traction. In the case that this long interest gain momentum, contrarian trading would suggest further weaknesses in the pound in the medium term. Analysis of a collection of technical indicators on the hourly time interval on the pound-dollar cross is suggestive of a temporary bullish market sentiment and recommend short positions on the dollar. The pound-dollar pair opened today's Sydney trading session inching closer to the established support at 1.6016, while the resistance is set up at 1.6040. The pair double-dipped below the 200-day simple moving average at the beginning of this week's trading session and hasn't managed to regain the 200 days, which allowed the market to continue to revise the long-term outlook on the cross to bearish if it continued to hold below the 200-day simple moving average. The significance of the 200-day simple moving average cannot be understated, as 200 days contain more or less of 1 year's worth of trading data. This bearish sentiment is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30-day short-term moving average, which is indicative of a sell recommendation on the short-term moving average front. Moving along to the fundamental aspect of the pound-dollar market, the highly anticipated risk event stemming from the UK this week was the BOE's MPC's minute release. The market was eager to see whether there was a change in the MPC's rhetoric and how this will affect the UK's interest rate expectation. Despite a 7 majority vote to keep interest rate unchanged, the sentiment amongst the MPC have turned dovish, and as a result of that, this sent the pound tumbling 100 pips. The BOE's rhetoric is very suggestive of a weaker UK economic outlook coupled with prior CPI print beginning to lose momentum, which reinforce the notion that hiking rate would be a premature move at this point. The latest UK inflation number is shying away from the BOE's 2% target, while the average wage growth continues to tick lower than inflation at 0.7%. With fear that the EU may be experiencing a double-dip recession does have a detrimental effect on the UK's export market. A weakening in UK's fundamental would only drag the pound interest rate expectation. This is self-evidenced in yesterday's release of UK's BBA mortgage approval number, which came in at 39.3k, below the 41.5k expectation. In addition to that, the UK retail sale month-on-month for September contracted by 0.3%, marginally below the forecast of 0.1% expansion. UK core retail sale also contracted by 0.3% below the expectation of a 0.2% contraction. This weak retail numbers may undermine today's UK GDP quarter 3 year-on-year print, forecast to roll in at 3%, while its GDP quarter-on-quarter for quarter 3 is expected to expand by 0.7%. Over in the United States, the dollar continues to defy gravities as it rides alongside with risk appetite. The US equity market rebounds during yesterday's trading session, and speculation is running high on Fed's rate forecasts. Housing recovery in the US is showing sign of gaining traction, with Monday release of US existing home sales for September coming in better than expected at 5.17 million, when forecasts set at 5.1 million. This translated to a 2.4% expansion, beating a forecast of just 1% expansion. In addition to that, despite a weaker than expected CPI reading for September coming in at 0.1%, when forecast expects a 0.2% expansion, the yield curve on US Treasury continued to rise on rate hike expectation. Wrapping up this week trading session is today's US new home sales, expected to come in at 470K. The highly anticipated risk event for the dollar will come next week during the FOMC decision to wrap up its final tapering for October, as well as the release of Q3 GDP number. I want to thank all our listeners for their time and have a successful trading day.